Hi everyone, my name is Lizaki from One Side Finance. Today, I just want to explore and show you about rebalancing your loan, restructuring, and going through what it's called debt recycle. So, I'm gonna start giving you a scenario so that we can relate to the calculation better. So, for example, you have one owner-occupied property, and say the title is under Mr. and Mrs., a couple. Whenever we assess our client's loan, we're always making sure that we know who's on title. And if it's a joint ownership, we want to know the percentage of ownership. Okay, it's very important later on when you want to buy investment property that we know the exact percentage for negative gearing purpose. So, say for example, the property value is 1 million. This value will be confirmed later on with the actual valuation from the bank, which can vary between banks. But let's just say for this example, $1 million. For each of the existing loan, we want to know what is the loan balance, what is in the redraw, because if you have the balance of 700 and the redraw is 100,000, the limit is 800,000. 800,000 is it's what we have to input into the servicing calculator to work out the borrowing capacity later. And we will also ask you to let us know the rate and the remaining term, which will help us doing the calculation of the borrowing capacity. And then you said to me, Liz, I actually want to buy shares. And I want to make sure that the loan that I'm buying the share with is tax deductible. The rule number one, my disclaimer is I'm not an accountant, so I can't give you tax advice. But the rule number one is not to use the money from the offset account, because if you use the money from the offset account, then you pay more on your home loan, which is a non-tax deductible debt. So what we do is we will create a separate split, a totally separate split, not linked with the owner-occupied, but it's still secured against your owner-occupied property. And you said to me, Liz, I want 200,000 to buy shares. Now, this means that at the moment, your total limit will be 800 plus 200. Okay, so that's not possible to borrow 100%. So what I would then suggest to you is this. The redraw. Do you need to have the redraw for the future? Because redraw is you've paid an upfront payment of 100,000 and it sits inside the loan. You can take it, if you take out the redraw and you spend it, then your loan balance will go up to 800. And then you will say, I don't need the redraw. I still got 300,000. So I'm gonna delete the redraw. And to delete the redraw, either you call the bank, or if we refinance to another bank, obviously then we will restructure and get a new limit, right? But that's example. Now the total limit is 900 against $1 million value. Still not good. You can, but then you have to pay mortgage insurance unnecessarily. Then my next question would be, all right, let's make it 80% so that you don't pay mortgage insurance, you get a better rate. Are you okay to sacrifice 100,000 of your offset to reduce your owner occupied? So then your owner occupied will the limit will go to 600,000, and basically then you release 200,000 new split for your future investment, so that now your total is 800,000. 800,000 against $1 million value, then it's the loan to value ratio, LVR, is 80%. Perfect. So this is what it's called by sort of debt recycling. This is the definition is to convert non-tax deductible debt into tax deductible debt. So there's bad debt and good debt. So I guess the owner occupied loan, because it's non-tax deductible, sometimes it's categorized as a bad debt, but it is not really a bad debt because you are building your wealth as well. But you get what I mean. The investment is tax deductible. Ask your accountant, but this loan is only tax deductible if you use it to invest in an asset that generating an income as well. Okay, so just making sure that it's used for the right purpose. So then That's what's called debt recycling, and that's how we sort of rebalancing the portfolio to achieve what your goal is to buy the shares. But also, you said to me, Elise, I want to take equity out to buy a new investment property. We will do the same calculation, but instead of 200,000, you use it to buy shares. You want to buy an investment property, and then we will basically look at, okay, if the price is, I'm just giving you 800,000, and the cost generally will use 5% to pay stamp duty, solicitor, and government charges and all that. Except if you purchase in Victoria, we normally tend to budget 6.3% because this Victoria state has higher stamp duty. Say you use a buyer's agent and it costs you 20,000. Okay, so the loan is going to be 80% to avoid mortgage insurance. Then your contribution that required is the price plus the cost plus buyer's agent's fee minus the loan, which is 220. Oops, you only have 200,000. And then what we do is we can say, okay, then can we, if we need 220 in here, then I will ask you again, is it possible to reduce your owner occupied lower using the offset? If it's possible, then we will reduce it to 800,000 minus 220, 580, for example, from 700 before, right? So 700 minus 580, then you will use 120,000 of your offset to reduce it to 580 so that you can release 220, and the 220 is used as your deposit and contribution to pay the cost to buy your new investment property. Only if you're okay. Some people say to me, there's a reason why I've got 300,000 in the offset. I don't want to touch it. So it's okay. It's up to you. But then obviously then you can't take as much as equity as possible to achieve the goal to buy the investment property. But that's kind of how we do the restructuring to reduce the unoccupied, to release the equity to buy another investment property. Now you will end up with 3 loans in this case. The loan 2 and the loan 3 will be tax deductible for this investment property. What we do later on in the future is, it's quite annoying to have 2 different loans. Whenever you do your tax return, you have to keep giving the accountant to different loan account when you claim the interest. We will keep checking the LVR of this property. One day, when the price has gone up, then we can merge loan 2 to loan 3 together so that we're going to tidy up the structure so that you have one property against one loan only instead of 2 like this. And then that allows you then to free up more equity here for the next one. So, and then we also check the equity for this property to see if there's any room to borrow more to fund your next investment property. So I hope this example helps in terms of explaining how do we rebalancing, restructuring, and doing debt recycling for our clients. Any questions? Just let us know. See ya.